afternoon, ladies and gentlemen, and welcome to this virtual Nordic update. I'd like to introduce Paul May, Head of Real Estate Equity Research at Barclays. Thank him for his hosting of the event in advance. I'd also like to thank Diös, Fabege and Pandox for their participation. A couple of events that EPRA has over the next few months worth noting before we pass on. Thursday, 20th of April, EPRA and Bloomberg Intelligence Finance Summit in London. And then on Thursday, the 8th of June, we have EPRA's Summer Corporate Access at Chelsea Football Club, also in London. We look forward to seeing many of you there. And without further ado, I'd like to hand over to Paul to take us through the virtual update. Over to you, Paul. Thanks.
Thank you, Matt, and welcome everyone to this virtual Nordic update. As Matt mentioned, I'm Paul May from Barclays. Pleased to have on the line from Diös, Knut, Rost, Johan, Dernmar, from Pandox, Anneli, Lindblom, and Anders Berg, and hopefully joining soon from Fabege, Bergström, and Peter Kangert, for what should be an interesting discussion on the current state of affairs and the outlook in the Nordic property markets. Obviously a lot happening at the moment, so it makes it quite an exciting place to be discussing. I'll initially pass over to the management teams for a quick overview presentation and follow that with a Q&A discussion. But enough from me, firstly passing over to Knut and Johan from Diös to go through their slides.
Thank you, Paul. I'm trying to share our screen. Hopefully you can see our screen now.
Well, I'm Knut Rost, I'm the CEO of the company, and thank you for the opportunity to present the company and Diös and us. We are a large real estate company now in the northern part of Sweden. We are now listed at a large cap in Stockholm. As you can see on this picture, you see that we have focused on 10 cities in the northern part of Sweden. Every city part of this green transformation that's going on. And maybe this is the hottest spot in Europe just now. There's a lot of investments going on. And we are pleased to see that we have chosen the right cities. In the beginning, we chose those cities because they had universities, they had municipalities with high ambitions, a lot of companies, and the population are growing in every city. That's very important. So let's say that we are working a lot with urban development, and we are not satisfied with working with just one property. We want to work with a whole block. That gives us more opportunities with building rights and so forth. We are now the biggest real estate company in this part of Sweden, in the northern part. And as you can see on the chart, we are growing. But we try to grow in a clever way. We are very concerned that our yield is good. And we say that we are a cash flow driven company, and I think I will say that in the future as well. Our property value is now 31 billion Swedish crowns, and the number of properties is 360. We have a lettable area of 1.6 million square meters. The difference between our market and, for instance, the Stockholm market or the bigger cities is that we have, of course, lower rents. When I appeared in this company, the rent was about 1,000 Swedish crowns per square meter. Now we are talking about 3,800 crowns per square meters as the highest. And we are aiming for 3,000 crowns per square meter in every city. And of course, we are going to talk more about our market when we talk about the green transformation. And with a little humor in it, we talk about the green revolution. As you can see, we have a very diversified top line. But the thing is that we want mostly to work with offices. That's our main focus. And a typical Diös house in those cities has some sort of retail or office in the street level, 2 or 3 levels with office, and then maybe story 4, 5, and 6, or maybe 7 is office or residential. That's how we work, and we will continue to work that way. The great thing with this is that we have a lot of government-related entities in our rental list, nearly 30%, 28%, and that's very good. We think mostly because they want to establish more offices in our cities, and of course they are good in paying the rents in the right time. So we can state that we have a very strong and stable cash flow. And talking about the CPI-linked rents, which has been the topic for the last 3 months, I think, in Sweden, most of our lease contracts are 100% linked to the CPI, 93%. So that means that we will have an increase in rents for 2023. Now I will hand over to Johan.
Yes, and some words about financing. We have been for a long time running a high share of bank debt on our balance sheet. And nowadays the capital market is a bit rougher, a bit tougher to access, and we're very glad to have those relations with the banks that we have. As you can see, 80% of our outstanding debt is within banks, and we have some also unsecured green bonds, some commercial paper, and some secured bonds through our financing vehicle SFF. We are aiming to be a issuer on the capital market, but that's these levels as we see in the market today. We will not refinance our bond maturities on the capital market because it's too expensive. We have an LTV of just below 52%. We have a target to be below 55, and with the high cash flow company that we are, we see that as a good level. But if you look at more cash flow driven key ratios, the net debt to EBITDA, it's currently at 11.7 times, and we have been around 11 to 12 times for the last 5 years, so to say. So very strong cash flow from the operation, and that motivates why we're running an LTV above 50%. Also worth mentioning is that we don't have any public rating, which is beneficial in these days, so to say. So we feel very comfortable for the years, the maturities we have on the financing side for this year, that we could refinance that at quite good levels, actually. Going into the operation and the net letting is that we have very strong momentum from the operation. Looking both on new lettings, looking at the occupancy rate, but also on the surplus ratio. Like for like, rental growth was 6.7% in Q4, which is the highest numbers that we have reported. And noted that we will have the CPI into the rents for the first quarter, so that figure will increase. 17 of the last 20 quarters we have been having positive net lettings, but as you see on the chart, the last year has been very stable and an upward going trend, with a lot of new leases in the market, and that reflect the demand that we see in the market, and I think it's just the beginning of this green transformation. Looking at surplus ratio, as you saw on the map, we're running our business in the northern part of Sweden, so we have the winter-related cost, of course, affecting our result for the first and fourth quarter of each year. But it has continuously increased from 64% up to 68% for the full year of 2022. I'll leave the word back to Knut.
And as we talked about before, it's very important to have this vibrant market. And now we are at the epicenter of this green transformation in the northern part of Sweden. Actually, this green transformation is actually occurring in all Sweden, but it's a little more in the northern part because of the commodities that we have in the northern part. The Swedish industry is transforming towards net zero emissions, and that green revolution has a great international focus. If you go by plane from Stockholm, for instance, to Luleå, everyone speaks English on board. That's something new. The things the market is doing up here is making clean green energy. For instance, energy is one of the most important topics we talk about. We have access to land. We have natural resources and commodities which are in this area. The climate is very good. It's colder in the summer and it's very stable along the year. And we think as well as the Swedish legal system is very transparent, solid and predictable. There's nothing else going on. It's a very predictable decisions from the governments. We talk about in the last few weeks, we are talking about 100,000 more people in this region. And of course, that sets a lot of pressure on us to arrange for more residentials. And maybe there's more fly in, fly out. So we're talking about long stay. But the main thing for us is actually to provide for these private entities and companies with office space and premises. But we work also with gyms, we work with kindergartens and so everything that's needed around those industrial plants. And as a market leader, we are in the sweet spot for this development.
Yeah, just to conclude our short introduction of the company, why you should invest in Diös. As we stated, we have a very strong and solid cash flow. We have a yield gap at the end of December at 2.5%. And also, as you saw, the very stable cash flow from government-related entities, from different types of premises in a very growing market. We have a long-term sustainable business model. We only buy clean energy. We have already today very low carbon emission in our operation, working continuously to reduce also the carbon footprint from our project side. So that's something that we're focusing a lot on these days. As Knut mentioned, the great market conditions that we are see appearing on as we speak. New establishment, new investments are announced, I would say, each week, and with a magnitude that we haven't seen in this part of Sweden or maybe in Europe before. And the effect of these investments, we are beginning to see these on our top line, but we think there's a lot more to come. We have local teams in each of our cities, which is I would say a unique selling point. We are ahead of our competitors. We know what's happening in the cities, and we have a good position to affect also the local authorities how to develop these cities. And last and not least, we have very good bank relationships. These days it's very good to have have a good good hand with the banks, and I think that's one of the key success for our future growth. So that was the short presentation from Diös. Thank you very much for listening. I think I'll leave the word back to Paul.
Thank you, Johan and Knut. Very interested there in terms of the impact on green on the north of Sweden. We now move further south, passing over to Fabege to sort of hear their views on the Stockholm market and sort of how they're sitting and how they're seeing things. Over to you, Asa and Peter.
Thank you. Can you hear us now?
We can indeed.
Good, very good. I think we need your help to share the presentation that Peter sent over to you.
I'll leave that in the capable hands of the EPRA guys.
Or we could start and while we're waiting for the.
There we go.
Anna, can you please turn to page 2? So my name is Peter Kangert, Head of Investor Relations at Fabege. A short introduction to Fabege in brief. We are 100% focused on the Stockholm market. We only have 102 properties, but a property value of approximately close to 90 billion Swedish crowns. And what does make us a little bit unique is that we're not only focusing on Stockholm. In Stockholm, we are very focused on 4 different key areas. Because we believe very much that you have to be close to your clients, you have to be close to the market to get the feeling of the trends and the needs for the customers. And what all of these 4 areas have in common is also that they have excellent communications with either rail or buses or subway. Because one of the key things that all management teams now are thinking about is how to get the people back to the office. And then location will be more and more important. And if you can't provide a modern office in a good location, then it's very, very difficult to get people motivated why they should commute 45 minutes or longer by car if the office is not attractive. I wouldn't do it, but we have a nice office, so I do it. Very good. So a little bit about why we are in the Stockholm market, and we are such focused on that area. And please, also tell us a little bit more about our financial situation. I think that's most of the questions we get from investors these days.
Yeah. We can turn to the next page, please. So financing has been a hot topic ever since, the war started 1 year ago, maybe more apparently after the summer. Fabege, we used to be around 50% in bank, around 50% on the capital market. And due to the conditions that also Diös talked about just previously, we have been more and more shifting towards the banks. So we are very happy that we have all the banks with us and that they are willing to increase the lending to Fabege under these circumstances. Now, actually, yesterday, we did the first bond issue since April. So we issued 250 million in a 2-year bond, a tap on our February 2025 bond, and at a margin of 200 basis points. The margins have been sky high for ever since the summer, and they have gradually started to come down towards the end of last year and in the beginning of this year. And we set a target that we want to be active on the capital market if we can find conditions that are more in line with long-term financing in the banks. So we set a target of issuing a bond should we reach the 200 basis points in margin. And yesterday we had some investor interest that met this target. I think that's very good for the market. We still think it's a little bit too expensive, but we wanted to be present and support this market and open up the market a little bit. Apart from that, we have, as you can see here, undrawn facilities of 7 billion. We have collected some new bank financing in order to meet bond maturities during this year and also investment needs. We are not only owning property management properties, but we're also investing quite a lot in new production, not at least in Flemingsberg, the area which is on the south side of Stockholm, where we have 2 ongoing projects. We also have a few ongoing projects in Arenastaden, and we are expecting to invest roughly 2.5, maybe even a little bit more during this year. We have also worked with the maturity profile, which is close to 5 years after the prolonging of bank facilities last year. We have the investment grade rating from Moody's, which makes us want to refinance at least 12 months ahead of maturity. So this is an ongoing process. We also have the fixed rate period, interest fix of nearly 3 years, of which roughly 50% of the portfolio is fixed on terms longer than 3 years, which gives us some headroom now that the interest rates, the market interest rates are coming up. So I think we can turn to the next page. And on this page, you can see the sources, different sources of financing where bonds have been, where we have had access to money during the last years, and where we have now shifted towards more bank financing, secured financing. And I think also for Fabege, since we have a very low LTV, less than 40%, there is plenty of headroom for us to secure financing should we have to. Now, with the bond issue yesterday, I hope that we will see improved conditions on the bond market and that we want to be a more active part on this market too going forward. But we will see. We are preparing for shifting more financing towards bank in case we don't see this improvement. We also had a new financier last year, Nordic Investment Bank, which is new to Fabege, and they only finance really green projects. So we had one example of a very green project, zero energy building here in Arenastaden in Solna, that was financed by Nordic Investment Bank. Next page, please. And here you can see the fixed rate profile of the portfolio. We make this sensitivity analysis that 1% increase in the market interest level generates an increased cost of Fabege of approximately 100 million going 12 months ahead. So yes, we are sensitive to interest rate increases, but we have some headroom with the fixing also. And next page, please. Also some information about the rental market in Stockholm. I think it's a very stable market. We have not had any specific discussions with our tenants due to the indexation increase that lifted rent levels, almost 11% with the start in the beginning of this year. From this list, you see the 10 largest tenants in Fabege's portfolio. They represent almost 30% of rental income. And if you take the 25 largest tenants, they represent more than 40% of the rental value in our portfolio. And these are, as you can see, very large, very stable companies where we don't see any risk. And the majority of them also are in really long lease agreements with us. I would also say a comment on the net letting. We had 4 quarters of positive net letting last year, which is also an indication that the market is working. And I think not only in Fabege, but in many of the other really Swedish real estate companies, you have seen the same with positive net lettings during 2022. And it also looks positive in the beginning of 2023. And we have several ongoing discussions, both for renegotiations in existing contracts, for new lettings in the property management portfolio, but also for project lettings. So we are quite optimistic about the future now. And then finally, if you turn to next page, please, a few words on the sustainability work in Fabege, which is very much, I would say, incorporated in the organization and very much driven by everyone in Fabege. We have a long-term target of climate neutrality to 2030 and to reduce the impact, the CO2 impact in new production with 50%. And we have now set interim targets on the way to 2030 to make sure that we can follow and make sure that we can reach these targets. We also introduced a new circularity index where we say that at least 20% in refurbishments and new production should be reused material in one way or another. And we are reusing much material in the ongoing projects that we are doing together. There's one very good example of what we called the sustainability house here in Arenastaden, where we built a new, you can say, small office of around 1,000 square meters only, but it was built with 70% reused material. And all the inner decorations and furniture were reused material, and it looks very new. So it's also a way to learn to the future. We also managed to reduce the electricity consumption by 11% in the fourth quarter in comparison with the last year. So this work will continue very much. And I think that's about time. It goes quick, but do you want to add something, Peter?
Yeah, you can just add that we have 100% green financing and 100% of the management portfolio and project portfolio are certified according to the BREEAM system. It could be a good thing to know about us. Now back to you, Paul.
Fantastic, thank you very much. And now on to Pandox, last but not least, to give a view on the hotel market. Obviously, very different situation to the office side. But I pass over to Anneli and Anders to give an update on where Pandox is at the moment. Thank you.
Thank you. Welcome to Pandox. Could you share our presentation? Perfect. So we can go to the first page then, or the second page. So welcome to Pandox then. We have a well-diversified hotel property portfolio. We only do hotels. We don't have any offices or residentials or so. We just do hotels, and we love hotels. We have 157 hotels. We have around 35,500 rooms and a property market value on 69 billion kronor. We have two business segments. The main one is property management, where we lease hotel properties to strong and well-known operators. We have long leases. Unexpired leases terms are now on 15 years on average. And the most important is that we do have revenue-based rental agreements with minimum levels. The other segment we have is our operator activities, where we run the hotels ourselves in properties that we own. Today we run 20 hotels and operator activities makes up to 70% of our property market value. The focus of our total property portfolio is upper mid-market hotels with mostly domestic demands, which is the backbone of the hotel market. It is also strength in more uncertain economic times. And as you can see on the right on this slide, we have a strong network of brands and partners in the hotel property industry. This ensures efficient operations and revenue management, which maximize cash flow and property values. We work together with several well-known operators, for example, Scandic and Nordic Choice in the Nordics. We have Leonardo Hotels in Germany and UK. And we also, of course, have long relationships with strong international brands like Hilton, Holiday Inn, and Radisson Group. So that's sort of a quick view of Pandox. We did end the year strongly with stable demand and normal seasonal patterns in the fourth quarter. For Pandox, the positive market conditions translated into strong growth in cash earnings on the back of increasing revenue-based trends and good development in our own operated hotels. This confirms the power and performance in our business model and what we are capable of delivering in a more normal hotel market, since we have had the pandemic previous that really have affected us. We do have a solid financial position with an LTV on 46.7%, which is in the lower end of our financial target range. And it is, of course, also worth mentioning that we have all of our financing 100% through banks. We have no market financing in form of bonds and no external rating. And we do have good and constructive dialogue on future refinancing with our banks. And the board did propose a 250 krona per share for dividend for the financial year 2022. And next page, and I hand over to Anders.
Thank you. This is perhaps not the most common data point for property investors, but it's very important for us in the hotel industry. And this is RevPAR, which is occupancy multiplied by average daily rate for a hotel room. And this sort of illustrates the underlying performance of the hotel market. And this is RevPAR for the property management portfolio. And you can see that there are 4 lines here. We have 2019, which is like the comparison year. That's the year which everyone is comparing actual sort of daily progress in relation to. And then you can also see what the situation looked like in 2020 and 2021. And you forget quite quickly for various reasons, but 2022 started out relatively weak with a high level of restrictions in basically all markets. So we started the year at a much lower level compared to 19. But as restrictions were eased towards the end of the first quarter, there was a rapid improvement, and we will say on a sequential basis, month over month in basically all markets. Which put us in the fourth quarter basically at the same level as we were in 2019. So quick and strong recovery. And based on these 2 parameters, occupancy and ADR, occupancy is today approximately 5 to 10% below 2019 levels, but the price development has been even stronger. And prices are on average some 10 to 15% higher than they were in 2019, which means that RevPAR as a whole has actually now surpassed 2019 levels. And as you can see also, and Anneli mentioned that, and this is a good thing, normal seasonality in the hotel market is now back. And that means that Q4 and Q1 are normally seasonally weaker quarters, and Q2 and Q3 are the stronger ones. That's that. Back to you again.
Yes, next page, please. Oh,
You can go back.
Go back
one
one.
more.
Then,
That's the right
perfect,
one.
perfect. So we did have Q4 was another quarter with strong growth in cash earnings, and it increased to 550 million, driven by solid earnings improvement in both of our segments. For the operator activities, where we actually run the hotels ourselves, the net operating margin ended at 24%, which is well in line with the year 2019 that we usually compare to, sort of more of a normal year for the hotel industry. And as said before, we have a solid financial position with cash and unutilized credit facilities on 4.5 billion SEK at the moment. Next page. Just a quick look at the property values. So on this slide, you can see the accumulated change in value in our property portfolio since the start of the pandemic in the beginning of 2020. During the most uncertain phase of the pandemic, we had a negative changes in values in 6 quarters in a row, mainly due to lower cash flows in our hotels. From the third quarter, based on gradually improving cash flow, changes in value turned positive again. And in the fourth quarter, we have had a slightly negative, as most of other property owners also have had. So on the right, you can see how increasing yield requirements and strong cash flow have affected our property values. For the full year, a stronger cash flow had a positive value impact on approximately 2.8 billion, while higher yields had a negative impact on approximately 1.3. And for the fourth quarter, isolated higher cash flow and higher yields were largely balancing each other out. So let's have the last, next page, please. Market.
Yeah, very quickly on the outlook for 2023. We have a very profitable business model. We have strong cash flow and a solid financial position. And in 2022, we again proved sort of what we're capable of delivering in more normal market circumstances. We have, to a large extent at least, variable revenues. We only have a small portion of fixed leases. The vast majority of our revenues are variable. And it's not a one-to-one relationship, but they offer meaningful protection about both sort of cost inflation in the underlying operations and also as a compensation for higher interest rates. Energy and financial cost will increase in 2023. That is it's just a fact. But on the variable revenue side, some protection will be offered. We see from a market perspective additional demand potential from both business and particularly international travel. Chinese travelers have been non-existent for the past 2 years in the global travel market, and now with restrictions are being lifted there, that will have a positive impact on general market conditions, particularly in the second half of 2023. And risks, I mean, I guess we more or less share the same sort of risk map, and what we consider to be the biggest one remains the war in Ukraine and the direct and indirect effects from that. Yeah, that concludes our presentation.
Thank you, team. That's super interesting, super useful from an operating sort of exposure perspective. I think we're now moving to sort of Q&A discussion point, and so from my side, I kind of see sort of 6 or so areas of discussion. Obviously, the financing environment, which we've all touched on in the opening discussions. Moving on to the operating environment, and quite interesting how those two dynamics are playing through. which kind of then feed into property valuations, kind of impacted by both cost of capital and the operating environment. That then sort of drives the leverage position of businesses and how companies and how we're seeing that moving forwards. I think it's then interesting to touch on how this environment relative to probably the post-GFC period actually could be more interesting and more advantageous for property professionals such as yourselves, rather than necessarily some as what we would describe spreadsheet investors that just play the low interest rate environment. And then on to kind of funding of those opportunities that might arise in the current environment and the growth that may come of that. But I think probably starting then on the financing environment, and I appreciate you've all touched on this and highlighted obviously exposure and good relationships with the banking side of the equation. I mean, on our sort of view, and I appreciate it's a daily moving situation, but current financing costs at banks looks to be around about 4.5% to 5%. I think obviously that has increased materially over the last few years, and I appreciate over the last few months. It's all moved very, very quickly. But I appreciate that is still cheaper, or seems to be cheaper than the bond market. But I suppose first question to Knut and Diös, but it'll sort of flow through for everyone, I think, because it's quite important. How are you seeing that funding environment and access to capital, and then the cost of that capital, influencing any decisions that you might be making, either on investment or on growth potential?
Yeah, of course, there's a changing environment, and you need to be humble in this in this volatility that we have seen on the market and interest rates for the last 9 months, so to say, since the central bank started hiking rates. We are definitely a bit more cautious, of course. We need to see each decision in the light of financing opportunity. We think, and we as we said in the presentation, that we have a strong cash flow from the operation, and as things looks right now, we see continuously good cash flow generation from operations. So we could fund a lot of our committed capex through the running cash flow. Looking on growing the business and making acquisition, we're currently in several discussions, both on the buying and selling side. So, but of course, you cannot act as we did maybe 1 or 2 years ago, where you could expect when we do good investments, you could have property value uplift, and you could put new lending on the new higher values. We see property values develop quite stable from here, from where we sit. We continue to do great kind of investments with good profitability. And I think that's with the banks close to our business, and with the market that we see is developing very strongly, we think we can continue to do good business, but of course in a more cautious way, and we are humble for the current environment.
I think similarly to you, Asa and Peter, coming from a slightly different starting point with a negative spread to marginal financing costs, if you look at your property yield, how are you thinking about the world moving forwards in that investment, and is it an attractive investment for you to continue to make?
Well, we are not really actively searching for new acquisitions, although we always have the ear towards the market, listening to what's out there. Not that there is so much potential transactions on the market where Fabege is located. We have, last year, we acquired 1 property in Flemingsberg. It's just land that fits in with the rest that we are going to develop in the future in Flemingsberg. And we bought one cash yielding property also on the south side. In the beginning of this year, we have sold some building rights to JM, residential developer in Sweden. So I think that was a very good deal, both for JM and for us, since we were selling building rights that were not actually in our core areas, and they were not yielding any cash at all. So it helps in financing of the ongoing projects. And we have one property out on the market for sale now. It's a mix of a residential and office building in a city area called Östermalm in Stockholm, which is not really an office area, where we are targeting private companies, private investors, and there's a lot of interest for this property. I think if we come to a conclusion with selling this property, that will also, we will use the money for investing in our existing portfolio. And as I mentioned in the presentation, we are investing roughly 2.5 billion in existing properties or new production properties. And we are investing in new cash flow, producing new cash flow. So these investments will have the potential to generate a little bit more than 400 million in rental value on an annual basis. So that's really the focus for us. I think with the strong balance sheet that we have, with the LTV level less than 40%, there is room for us to continue investment. And we have always worked with looking for more potential in the portfolio. And just as Johan mentioned before, it's not easy in the same way because you cannot count on increasing values these days. But we see that we have a stable cash flow. We are on a stable market, and we are investing for generating more cash flow going forward.
Thank you very much, Rost. And then I suppose slightly different, as you mentioned in your presentation, Anders and Anneli, with regard to obviously the more operational exposure that you have, the variable rent exposure. How are you kind of seeing that affected by financing costs, which I assume also impact some of your underlying tenants as well in terms of their position, and energy costs as well, and from your side, the financing costs and the operations? How are you seeing those two things balancing out in the current environment?
Yeah, I can start and you can fill in. Yeah, I mean, there are different parameters as you say. I think it's important to note that if we take our portfolio, the 85% are leased properties and 15 are operational assets. And the leased assets, I mean, in those contracts, the operators are bearing sort of the full cost exposure when it comes to energy and when it comes to sort of increase in staff costs and so forth. So I guess from a short-term perspective, that is more of a positive thing for us, because it sort of it increases the top line, because all these operators are working very systematically with revenue management, really managing their price position to compensate for these higher sort of underlying cost pressures. In our own operations, we feel the same pressures, but so far we have also been quite successful in compensating for it on the top line. And you know, things move quite quickly. If we would have had this discussion on the energy front, you know, 3 months ago, it looked much more severe than it actually does right now. But that said, I mean, we will have higher costs in the operational segment also from energy as old contracts expire, but it's a relatively small impact.
Yes, it is.
Well, thank you. And I think you've all touched on then how the so far stable operating environment is benefiting you, and you're seeing that rental growth coming through to offset. And I think that's sort of consistent across each of the different regions and sectors that you're exposed to. just something that we get asked quite a lot, and we still don't quite know the answer. But in terms of obviously your CPI coming in strongly last year, being passed through, particularly on the commercial side of things, into higher rents, how are you seeing that versus market rents? And we're getting sort of differing views, you know, market rents growing versus market rents stable, and inflation offsetting reversion. And just maybe to start with you, Asa, on the Stockholm market, how are you seeing that side from a top line and an market rent perspective versus CPI in place rents and the progression there?
Yeah, well, what we have seen in recent years is that we have had quite some uptick in rent levels, renegotiations in 2020, more than 10% in 2021, also 10% in 2022, 7%. But with the indexation uptick of nearly 11%, I would say that there is very little headroom for further improvement in rent levels. I think you have to look into different micro areas in Stockholm. Some areas, like the inner city, for example, there might be some headroom still. Rent levels are still shifting a little bit upwards, not steep, but at least they are stable or going upwards. If you look at Solna Business Park, one of our areas, for example, I think we are very close to market rents, in some cases, maybe even a little above. So in the renegotiations that we have started so far this year, we don't see really any trend. So we haven't had any evidence that we are above market rents. But I think we will have to be prepared for renegotiations being much tougher than we have seen in previous years.
And similarly for you, Knut and Johan, in the northern part of Sweden, are you seeing, appreciate no necessarily pushback on inflation upticks, but are you seeing a similar evolution on the market rents and renegotiations? Or do you feel that inflation has been passed through into market rents?
No, it's close to the opposite, I think. We come from a rather unmature market. I mean, we are in 10 cities, and we can see that this CPI level of 10.9% helps us to even more increase the rent. That's one of our main topics that we talk a lot about. And of course, we look at Fabege and all the other good companies, what they are doing, and we can see that we have a lot to do when we talk about drive the rents, so to speak. So you can see that we have a few top line tenants that pays about 3,500 crowns per square meter in large office premises, and we have too many that's paying around 1,500 crowns per square meter. So we have a lot to do. And if you looked at our key figures for Q4, you saw that like for like was a record, I think, 6.7%. And I think we will see more of that in the future. But it's getting steady up, so to speak. And I think a lot of those things, when we talk about rents, it's about our self-confidence when we are in renegotiation with our existing tenants. So we have to be more focused and more targeting the high rents that we have and aim for that level. So we have a lot to do.
Cool. Good to it always keeps us busy. And on for Pandox, to say it's a slightly different model, as you say, the variable rent. I suppose the question for you, asked in a slightly different way, would be: you mentioned obviously the cost increases that you're sort of finding from an operational point of view, both yourselves and the underlying tenants, able at the moment to push those through in higher rates for the rooms. Do you see any risk from either economic slowdown, cost of living squeeze for people, or any impact from more events like this in terms of a greater use of virtual discussion rather than in person? And At what point does that potentially put a squeeze on some of the profit margins within your tenant base potentially, and maybe either negatively affect or at least put potentially some pressure on that variable rent side?
I mean, we haven't seen it yet. It's always a question that we get: when are people going to stop travel? And it doesn't seem to be. I mean, when it was restriction, people did not travel. But as we can see, so far as we can see on the books that we have, especially in our own operations, we have still people traveling. And I mean, we are still missing some, as Anders said before, the Chinese people. I mean, it seems to still be a pent-up demand for traveling. And as we can see, I mean, our leaseholder, they are very interested in keeping the prices up. And since we still are missing some of the occupancy, we think it's gonna stay quite stable. We can't really see that it's going down, even if we do get that question a lot. But so far as we can see on the business on our own books, we can't see that it's sort of a demand going away. And it's also interesting I mean, we are discussing with that people are, you know, they sort of working in a different way now when we used to have this kind of meetings online. But we can rather see that people are sort of, they are traveling for more days. So they, you know, instead of going on a one-day trip to Luleå, they might sort of don't go that often. But when they finally go to Luleå, they stay for 2 days or 3 days. And we can also see that people are combining pleasure and business in a completely different way. So it's sort of, it's much more okay these days that if you go to Paris, you can stay the weekend. And if we compare with previous, we had nights, we didn't have that many business nights. They sort of ended on Thursday because people went home, but we can now see from the pattern that people are actually staying the weekend. So they go to Paris to have some meetings, and then they stay the weekend, and hopefully stays at our hotels.
Indeed. So I think bringing those two bits together, obviously a big question is on property valuations and where that sits, which is obviously a function of the yield on the property or the capitalization rate and the income side. I think you also sort of highlighted to a large extent cash flow inflation factors offsetting yield movements to a large extent over the last 12 months. Looking back at history, you know, it would suggest that Sweden has been a market that tends to operate with a more positive yield spread than maybe some other markets in terms of, you know, property yields versus cost of financing. With if we're looking at a marginal cost of financing of somewhere between, say, 4 and 5% or 4 and 6%, depending on the funding source, how are you sort of factoring that into decisions, and how are you thinking about how property valuations evolve over the coming period? So as inflation may slow, so that cash flow impact maybe slows down, but the cost of financing, looking at forward rates or whatever, appears to be broadly similar, may go up a bit and then come down a bit, but it appears to be broadly where we are today. How are you thinking about that? You know, is that a headwind to property valuations moving forward? Maybe starting with Pandox, seeing as we're unmuted.
But I think, I mean, as everyone sort of before us have sort of alluded to, of course, we are in a different environment when it comes to capital cost and you know, how to look at sort of your return profile. We are an international company, so we are present in 15 countries, and of course all these markets have their different yield characteristics. It's also quite big difference between the leased side of the business and the operational side of it, and sort of our basic idea is that yes, of course, we would like to get sort of the wind in our backs from positive valuations, but the mode of operation for us is more to try to drive value out of something which is underperforming. That is like the basis for us when we make acquisitions, when we work with our own portfolio. What sort of are there sort of things that we can do where we can use our industrial knowledge and expertise to drive sort of further cash flow out of the property. So we normally do that with like in a range of 18 to 12% largely when it comes to our own investments. And when we do acquisitions like we did last week in the UK, we are currently looking at between 9 and 10% in initial yield, or maybe stabilized yield, sorry. So we are working at a relatively high level, I would say, already. And I think that provides some cushion for us also in these market circumstances. But we have to be very prudent, and we have to challenge ourselves much harder than we had to do before the pandemic.
And just to follow up on that, how do you kind of reconcile then the acquisitions you mentioned at a very high necessary yield? And I appreciate that's probably underperforming assets that you're looking to improve upon. With, I think your in-place yield is about 5.7, I think, on a sort of blended basis across the portfolio. So how do those two things kind of reconcile in the current environment? I appreciate the cash flow side of it will be slightly different. I'm not saying your portfolio should go to 9, because I think that's a very different conversation. But just how do you sort of look at your existing portfolio versus acquisition opportunities?
I mean, it really differs, because as Anders said, we are in 15 countries, and I mean, it really differs depending on where we are. So we have sort of a portfolio that are very mixed with different kinds of hotels, and also what kind of market they are for them, and concepts, and what we compare them with.
Okay.
Yeah.
No, I appreciate it. It's a very difficult one. It's a very difficult one.
We would love to have them all at 9.
And yeah, moving on to similar question to move to Larsson and Fabege, where I think of the panelists, it's the one that has that negative yield spread to financing costs at the moment between property yield. How are you sort of thinking about valuation moving forwards, and is there a risk of further yield expansion given sort of history and where you sit?
Well, to start with, where the market yields are going is a little bit out of our control, of course. I think, of course, there is a risk that higher interest rates will also drive higher yields. But on the other hand, Stockholm is a market that is very much dominated by institutional investors that are not so dependent on borrowed money, but they need to find investments, yielding investments. And office properties within Stockholm have been very good investments for many years. And you can also see on the market that there are very few transactions occurring, and that many investors are just buying to hold, and they are happy with whatever yield they are getting almost. Of course, real estate may have been have given some opportunities during the last number of years, and higher interest rates can also give alternatives for that. But I think with the structure of the ownership on the Stockholm market, it has the opportunities to be quite stable going forward. And then when it comes to Fabege, I think we have some value potential to absorb in our portfolio. We have today an occupancy rate of 89–90%. If we can go back to around 5% vacancy rate, that would mean adding another 150 million in rental value into our portfolio. So working, and we have strengthened the letting organization during last year. So we are ready now really to put more work and to fight for each tenant. I think that may make some difference. And we know that we have good properties in attractive locations. So I think that should be feasible for us to come back to 95% occupancy rate over a couple of years. And then, of course, we have the project portfolio, where we have also opportunities to create a lot of value. We have a very good history of value creating properties. So we have seen strong value creation over the years in Fabege, and it has not only been market yields coming down, it's also been the projects that we have developed, not at least in Arenastaden.
And given that construct of the market, as you say, people with maybe differing views on the capital market, differing investment horizons, maybe not necessarily as professional investors as yourselves on the real estate side, do you see an opportunity to, or is there a case to be made that you more aggressively divest of assets in the next 12 months at potentially lower, relatively low yields, given that prospective financing cost in the, say, 4.5-5%, and then you use those proceeds as funding for investment in development? So effectively your funding cost for development is your sale, which is a 3.5% versus a cost of financing, which is maybe 4.5-5. Is that something you're thinking about, and do you think there is a potential to be able to do that?
Yeah, it's a potential opportunity to do so. But of course, we also want to be present, especially in the focused areas where we are investing a lot and where it makes sense that we control these areas, because investments are not going only for the property, it's also going for the whole area. So when we are investing in a property in Arenastaden or Haga Norra, we are not just investing in the property, we are investing in the city district. But there are several properties also in our portfolio that are either low yielding properties or that are not in the core areas, where we can make better use of the money elsewhere. We tend to say that nothing is for sale until it's sold, but we also listen to the market. So yes, there are opportunities for us.
Good stuff. And similarly to Knut and Johan at Diös, obviously slightly different market dynamics where you are, obviously higher starting yield, as I think you mentioned, slight positive spread to financing costs. I think even a positive spread to marginal financing costs. But historically, has been a wider positive spread. How are you managing that situation and thinking about that? Do you see, similar to Fabege, as potential opportunities to divest, or are you looking for potential opportunities to acquire underperforming assets or from others, just seeing how the market dynamic is in your world?
Yeah, of course, coming from a very, very positive yield gap to a little less positive yield gap, we are at a very good starting point. And just reflecting to our market, volatility in both market rents and property values tend to be a lot lower in the northern part of Sweden compared to the major cities. So we haven't had this yield compression that we have seen in different areas, both in Sweden and in Europe during this low rate environment. That said, I think we can conclude that we need to, as we said before, we need to push our rents, we need to do good investments to raise the property values, and we have a lot of things to do, but currently we investing in the current portfolio around 600-700 million at a yield of cost of 9-10%, which is very profitable, and when we do that we could also hike the rates a lot, and that's something I think will continue, and we see good demand for people or for companies requiring high quality, high accessible office space in the middle of these cities that we are the market leader in. So there's a lot of things for us to continue to do and continue to invest, and that's why we keep on invest in this environment, even though there's a great uncertainty both regarding interest rates but also regarding the macro development. But we think in the long end we could be both on a property value side, but also on the cash flow side, very profitable to continue to do so. Looking on the transaction market, of course, we have been net buyers for many years now. We have divested some assets that were not in the core market for us. What we are looking at is to divest more low yielding assets, looking at divesting assets with not so much potential in. So back to what Pandox said, we're always looking for potential when we acquire properties, and with this more uncertain financial situation that's on the market for right now, we also looking at divesting, and I think there's possibilities to do quite good acquisitions, maybe 6-9 months from here. But you always need to be humble. But we're running a strategy where we invest for our tenants, we invest in new builds, and looking on new builds in our market, there has been quite few of them. The economics hasn't been very profitable nowadays. When we can have 3,000 crowns per square meter and above, there's much more profit to build new buildings, and on that, by doing that, we could test the market for new higher market rents. So we think that, coming back to the questions about the property values, I think we have a lot in our own hands to prove that values should be quite stable from here. And with the market that we are seeing right now, I think that's our main take right now, that property values should be quite stable going into 2023.
And in terms then, just following on from that and work around, but on the leverage position, you say you think property values looking stable from here, with cash flows probably offsetting potential yield impact. How are you thinking about from leverage from a couple of sides? One, the ability to divest of assets should the valuations come down and leverage increase, versus potential acquisitions, as you said, on the transaction market, but also the impact of higher financing costs over time, putting a potential headwind to earnings progression over the next say 5 years as everything gets sort of refinanced at current rates.
Yeah, well, of course, financing rates hit us quite harshly nowadays, as we run quite short on interest rate maturity. Of course, that will affect the possibility to continue to invest, and I think I said it earlier, we have a maximum LTV target of 55%, and with the current uncertainty, we like where we are right now, around 52. So if cash flow is harshly affected, of course we need to look over the investment side, and we have around 700 million committed for this year in major projects, and looking on tenant improvements, they are quite short in terms of time to completion. So if the shit hits the fan, we could be quite rapidly to reduce our investments and start to deleveraging instead.
And it's sort of through an internal deleveraging rather than necessarily disposing of assets, or do you think disposing of assets as well?
And disposing assets could be one way, but that's also where we think the market is so strong, and from where we sit, there is a lot of buyers or investors looking to make a bargain of coming into the market at yields that we are not willing to accept. But if you could find someone that believes in our market in the same way as we do, and we could find a price that is I think quite fair for the long run and not make a short-term bargain with an exit strategy. I think there will be disposals as well from our side.
Okay, so we're still in a bit of a price discovery phase, I think, in terms of what you're saying from the buyers and sellers, potential sellers. Not that there's many sellers out there relative to the buyers, and then it comes down to, as you said, that operational outlook. I suppose similar question, and coming from a lowest leverage position in Fabege, obviously, I think it's sort of mid-30s at the moment, LTV. How do you see those dynamics from a financing side? Leverage position probably being quite strong, but then the potential headwind on earnings from that higher financing cost coming through. How do you look to manage that moving forward?
Well, it's as you say, it's always a balance between cash flow and a strong balance sheet. We are very happy with the strong balance sheet that we have. We set up a target never to go above 50% in LTV level a number of years ago. We are at 38% today, which gives us some comfort. So we are not at all worried about the ability to secure debt with banks, for example, or higher yields impacting valuations. We will still be very strong from that respect with where we are today. And I think, as I mentioned before, for us, it's more the ICR, and that we have low yielding properties, and we have a lot of investments in projects that will yield in a couple of years, but not now. So of course, there's always a balance for us. I think one thing with Fabege and the market that we are operating on is that there are potential investors if we want to sell a property. It's never going to be a problem. We are not looking to sell, apart from what I just told you before, at the moment, but there will always be a possibility if we think that we should have to delever. So I think, yes, it's something that we are, of course, monitoring on a daily basis. And it's also something that we have to take into account when making new decisions for acquisitions or for investments.
And in terms of those divestments, I suppose similar question or similar point that Diös made is that, do you see buyers at current market or current valuations, or is there still a bit of a spread between where buyers are looking to buy assets and where valuations are at the moment?
Well, you don't really know until you have sold, do you?
Very true. Very true.
But the property or the building rights that we sold to JM, they were in line with market valuation. We are expecting to get indications from this property that I was mentioned before in a couple of weeks' time. We know that there is a lot of interest from private potential investors. So I would expect that that the price will be in line with market value, not less.
And can you give a guide on where the yield is on that potential property? Is it above, or I presume it's above where your average property yield is?
It's actually below. It's because it's property which contains both office and residential. So it's quite a large potential portion of residential in this property. Very low yielding. Okay,
cool. Thank you. And similarly for Anneli and Anders around the leverage position and how you see that moving forward, and is that a benefit, or is it something that you're very conscious of in the current environment, and how that interest cost can impact on your P&L moving forward?
I mean, I would say that, I mean, we have just been through the worst phase you can imagine in the hotel industry with the COVID. So I mean, we did have quite hard discussion with the banks at that time. So compared to that, this is actually okay for us. But I mean, of course, the rents are going up, or sorry, the interest rates are going up, but we don't see. I mean, we are very, very low on our LTV so far. We're at 46%, and we have a range that we're supposed to be between 55 and 60. And I don't see a problem. I mean, as long as the banks are with us, I could really go higher than 46 at least. So I don't see that problem so far. You want to add?
No, I mean it's no nothing really to add to that, and we can also maybe we can add that coming out of the pandemic now after a few quarters we actually have a lower LTV than we had going into the pandemic.
Yeah.
So we have been able to sort of restore and sort of protect our balance sheet all through these years. Yeah.
And then,
CR is on a good level, so.
Yeah.
And then just, I suppose, bringing all of it together and trying to think from more of an outlook perspective from an opportunity. How are you all thinking about? Appreciate, we're in a bit of an unknown, crystal ball time, exactly where yields go and exactly where valuations go and exactly where leverage may go. But assuming the stabilization occurs, do you see a higher rate environment as actually being, to the point earlier, more beneficial for you as real estate professionals and have been in the game for a long time to maybe take advantage of the opportunities that may arise relative to others where it was simply a case of buy a property at 5% and finance it at 1% and everyone can make money in that environment? It's more difficult when you're buying at 5 and you're financing at 5.5 or 4.5 or buying at high yields potentially and investing. So assuming this rebasing comes through, just probably a very simple answer, over a sort of 3 to 5 year period, are you quite optimistic about the potential opportunities to grow, or are you still in that thinking about and concern phase, or cautiously optimistic, shall we say? Maybe starting with Pandox, say very, very quick as we're approaching the end.
But I think in such an environment, you will attribute a higher value to the industrial knowledge, the ability to create value out of something which is sort of underperforming, and that's really our sweet spot, I think, from an operational and strategic point of view. So for us, under reasonable inflation and interest rate circumstances, it could be good for us from a relative perspective, but of course it would impact in absolute terms the ability to create sort of growth compared to what we saw a few years back in time.
Sure. And similarly to Larsson?
Well, I think for Fabege, we can make the most potentials by investing in our own portfolio. We have a lot of building rights. We are creating these city districts in Arenastad and in Flemingsberg for 10 to 15, maybe 20 years ahead. I think we will not see any stressed sellers on the Stockholm market. I think it will be stable, and the ability to make new production will depend on the demand from potential tenants and how we can make our city districts attractive in comparison to other parts of the city. And we believe very much that we are in the right locations.
Perfect. And Johan and Knut?
I start where Åsa ends. I know we are in the right locations, and we have always focused on property management and craftsmanship, so to speak. We have never paid too much for any property. We have been rather cautious with what we have acquired. And I think nearly every key figure that we present, we can improve in 3 to 5 years, in 0 to 5 years. And with an occupancy rate at 91%, I think that is one we can, of course, improve. And I also know that we have been a little we haven't had that self-confidence in renegotiation, but we have started that now, and we start to measure it. So I think in the near future or in 5 years, we will improve every key figure we have, but we have to be very specific and focused on what we are doing.
Perfect. Well, thank you very much. And I think that probably wraps it up a couple of minutes ahead of schedule. But thank you to all the participants. It was great discussion, and thank you for the presentations. I'm sure everyone is available to answer any of the investor questions that may be coming from this. But from me, thank you very much, and have a great afternoon.
Thank you, Paul.
Thank you very much.
Thank you very much, EPRA.
Thank you,
Good
everyone.
hosting. Thank you.
Bye.